Last year, you paid taxes. Maybe 20%, maybe 30%, maybe almost half of everything you earned went straight to the government before you could even spend it. Now here's a number that should make your blood boil. The 25 richest Americans paid a true tax rate of just 3.4% on $401 billion in wealth gains between 2014 and 2018. Jeff Bezos paid zero in federal income taxes in 2007, a year his wealth grew by $3.8 billion. Zero. Elon Musk's salary from Tesla in 2024? Also zero. Mark Zuckerberg's official pay for Meta? $1. And the shocking part? None of this is illegal, not 1 cent. It is all perfectly legal, built into the system, by design. So the question isn't, are the rich cheating? The real question is, how does a system allow the most powerful people in the world to pay a lower percentage in taxes than a nurse, a teacher, or a construction worker? My name is Capital Explained, and today we're going to break down exactly how it works. No jargon, no politics, just the mechanics of how the system was built and what it means for you. Let's start with the first and most fundamental trick. Never take a salary. Income from work is the most heavily taxed form of money in the United States, the UK, and across Europe. When you earn a wage, you pay income tax, you pay payroll taxes, national insurance in the UK, social contributions across Europe. By the time it's done, a middle-class American earning $60,000 a year loses over $13,000 in payroll and income taxes before they even see the money. Now here's what the ultra-rich figured out a long time ago. You don't have to take a salary at all. You can own stock in the company you run. And stock is not income. Stock is wealth, and wealth is taxed completely differently. This is why Mark Zuckerberg officially earns $1 a year from Meta. This is why Elon Musk earns $0 from Tesla. This is why some of the most powerful CEOs in the world take what's called a $1 salary. They're not being humble, they're being strategic. Their actual wealth doesn't come from a paycheck. It comes from the rising value of the shares they own. And that rising value, it's not taxed until the moment they sell. Which brings us to Chapter 2. Here's how the American tax code works. You only pay tax on money when you realize it. In simple terms, you only pay tax when you actually sell something for a profit. So if Jeff Bezos owns $100 billion worth of Amazon stock, and Amazon's share price doubles next year, his wealth just grew by $100 billion. But he hasn't sold a single share. So in the eyes of the IRS, he hasn't realized any income. He owes nothing, zero. This is called unrealized gains, and for billionaires, it is the primary engine of wealth accumulation. Your salary gets taxed as you earn it. Their wealth grows completely untaxed until the moment they choose to trigger it. But here's where it gets even more interesting, because most of them never actually sell their stock at all. They've found something even better. They borrow against it. The strategy is called buy, borrow, die, and it is the single most powerful legal tax avoidance mechanism that exists today. Here is how it works in 3 steps. Step 1, buy. A billionaire accumulates enormous wealth in the form of appreciating assets, stock, real estate, private business equity. These assets grow in value every year. No tax is triggered. Step 2, borrow. Instead of selling those assets to fund their lifestyle, the billionaire goes to a bank. They use their stock portfolio as collateral and take out a massive loan at very low interest rates. Banks are happy to lend. After all, the collateral is worth billions. The loan is not income. Loans are not taxed. So the billionaire now has hundreds of millions of dollars in cash and has paid zero tax. Step 3, die. This is the brutal part. When a billionaire dies, their assets are passed to their heirs. At the moment of death, something called a step-up in basis occurs. Essentially, the original cost of those assets, what they were worth when the billionaire first bought them, gets reset to their current value. Any unrealized gains that accumulated over a lifetime are wiped clean. The heirs inherit the wealth at today's value, with no capital gains tax on decades of growth. Warren Buffett himself acknowledged his own effective tax rate between 2014 and 2018 was around 0.1%. He's openly criticized this disparity, pushing for what became known as the Buffett Rule, a minimum 30% tax on those earning over $1 million. Congress never passed it. Beyond the buy, borrow, die strategy, there's another layer: geography. Corporations and ultra-wealthy individuals have long used offshore structures to shelter income from taxation. According to the UU Tax Observatory, corporations shifted nearly $1 trillion in global profits to low-tax jurisdictions in 2022 alone. That is $1 trillion that was generated in the US, the UK, and Europe, but taxed at a fraction of the rate in places like Luxembourg, the Cayman Islands, or Ireland. Tesla, a company valued at over $1 trillion, paid zero federal income tax on its 2024 income of $2.3 billion. According to Oxfam, 23 of the largest and most profitable U.S. companies paid no federal corporate income taxes between 2018 and 2022, not $1. And half of the world's billionaires, over 1,200 people controlling more than $5 trillion, live in countries with zero inheritance tax, meaning that entire fortune passes to the next generation completely untouched. The EU Tax Observatory estimates that a coordinated global minimum tax on billionaires of just 2% on their wealth would raise $250 billion annually. That is $250 billion that currently goes uncollected every single year. None of this is a secret. It's all in the tax code. It's all completely legal. The question is why the system was built this way and whether it can be changed. Economists like Gabriel Zucman at the EU Tax Observatory argue that this concentration of untaxed wealth is not just morally troubling, it's economically destabilizing. When the bottom half of earners bear a proportionately higher tax burden than the billionaire class, it drains resources from the people most likely to spend them back into the economy. And for the average person in the US, the UK, or Europe, this matters. Public roads, hospitals, schools, and social safety nets are all funded by taxes. When profitable corporations and billionaires legally avoid contributing, the burden shifts elsewhere. The system isn't broken, it's working exactly as designed. The question is, who designed it and for whom? That's the conversation Capital Explained exists to have, not with anger, not with politics, but with facts, numbers, and clarity. If this video made you think differently about how money actually works in this world, that's exactly what Capital Explained is here for. Hit subscribe, because every week we're going to strip away another layer of the financial system that most people never see. If you enjoyed this video, share it with one person who would find it interesting. That's genuinely the best way to help this channel grow. And if you want to go even deeper on this topic, next week we're covering how the 2008 financial crisis happened, who saw it coming, and why nothing truly changed after it. Capital Explained. See you next week.